And people seem to say, well, that seems rather basic. Why do you have to say that? Isn't that what everybody looks for? Not so much. I mean, yes, it does seem common sense, but what that also means is we're not venture capitalists. We're not going to buy things on the come. We wish to see a demonstrated record of profitable performance and good returns on capital that exist for a demonstrable period. Because if you think about a business has to make money to succeed and last for a long time. If you have a business that, and I view that actually as a stamp of social approval, that the world is glad you're in business. Because if you have a business that's not profitable, that means one of two things. Either A, you might be doing some good work in something that's a fine thing, but the world doesn't really care. So, so what? Or secondly, you might be doing something that's very good, that the world needs and customers want, but you may not be good enough at it compared to your competitors, such that there's any profit left over for you. And that also isn't a very good circumstance or permanent situation. So if you really are going to invest long term, what you want to see is that you are providing a product or service for customers and you're doing it, something that they want, and you're doing it well enough that there's profit left over for you, because that seems to be a very good marker and an indicator that you'll be able to do that next month and next year and the year after that. And we're not traders. We're not buying and selling stuff. We're investing in things and trying to hold on to them for very long periods of time. So we want to see that notion of durability that would be implied by seeing that profit there. And we don't want businesses that need a whole lot of leverage, because what can happen is you can be very good at what you do, your customers can love you, you can be doing a needed product and service, but if it's over-levered, not zero leverage, and different businesses should have different types of capital structures to them. It depends on the nature of the business itself, and how much volatility there is, and how sturdy it is. But if you over-lever it, you can have the cards ripped out of your hand in the middle of playing your hand. We've been through a financial crisis where you saw that happen. Everything I've told you, everything I know how to do, I learned because I did it wrong somewhere. They got to learn from mistakes. They say the categories of people are that smart people learn from other people's mistakes. Average people learn from their own mistakes. Dumb people don't learn from mistakes. So I try to at least be average in learning from my mistakes, but that's where the learning would come from. So these things I'm telling you about are not theory. They're things I've done wrong and blown and said, I'm going to do it differently next time. So the idea of leverage and over-leveraging is one that I'm very cautious about. The second thing that we think about and that we look at, and again, this applies not just to selecting investments or selecting businesses, but it's also selecting and managing the people of the organization. We like management teams that have equal measures of talent and integrity, because one without the other is worthless. If you have somebody who has a lot of integrity but is not that talented, and they might be a nice person. You may enjoy having them as your neighbor, friend, buddy to drink beers at the quarter deck or play softball with, but in the context of the job that needs to be done, they may not be that good at it. So that doesn't do you any good. If you have somebody who has a lot of talent, but there's an integrity problem, well, that person may do well, but I, as their silent partner, probably won't. It's not going to end well. So we actually spend a lot of time trying to make sure that the values align and that we're oriented the same way to make sure that the integrity factor is there. We don't always get that right, but at least we think about it and try to get it right, which is a specific checklist step and process that we would go through. The third thing we think about is what are the reinvestment dynamics of a business, and that's a complicated way of sort of expressing. I grew up in Philadelphia, and sort of one of the cultural. Yesterday, it was Thomas Jefferson's birthday, and being a UVA guy, that's a big deal. So there must have been 1,000 emails from UVA, most 999 of which asked me to give them some money, reminding me about Thomas Jefferson's birthday. But around Philadelphia, the equivalent of Thomas Jefferson is Benjamin Franklin, and one of Benjamin Franklin's saying was, "Money makes money, and the money makes more money." It's compounding. So a perfect business is one that earns very good returns on capital and can take that capital that it's making and reinvest that at the same or better return next year and the year after that and the year after that. That's perfection. That's the North Star. The worst business in the world is one that doesn't earn very good returns on capital but needs gobs of it all the time. When you talk about big ocean shipping or something like that, just that requires just hundreds of millions, billions of dollars worth of capital investment, and then has, I understand that the freight rates from Europe to Asia right now are zero. Because of the economic circumstances, and there's boats coming from Asia to Europe with stuff, but to ride back to Asia to pick up another load, normally they'd like to backhaul that stuff. The demand is such that you're making zero. Well, our total investment in the shipping industry is zero when I see dynamics like that. So the second best business in the world is one that earns very good returns on capital, can't reinvest it all, but the owners know that, so they're very good at making acquisitions or paying dividends or buying back stock, managing their capital structure to keep the returns on capital at an appropriate level. And that's really the sweet spot of where you'll find stuff. It's extraordinarily rare to find something that can compound over and over and over again. That's a unicorn, and not just the unicorn term that's out in the financial press these days. And then the fourth and final lens that we would look at things through is valuation, price. What do you have to pay? And I find if I find the first three attributes, well, you can pay a fair price. You don't need to steal it. You don't need to bargain and dicker somebody and make somebody miserable on the other side of the table on a deal. If you find those first three things, pay up a little. Make the other person happy that they did business with you, because not only if you're right about those first three attributes, every day that goes by, that deal will look better and better. Time is the friend of a wonderful business and the enemy of a mediocre one, as Charlie Munger would say, who's Warren Buffett's partner, and makes the other person feel better. And the next time they have an idea, or the next time they have a good deal, who do they come to first? The person who dealt with them fairly and honestly and pleasantly, or somebody who beat the dog do out of them? We just think in the longer run sense, you just see more traffic and you see better deals, you build better relationships if you go about things that way. And that's been the hallmark of the way in which we try to construct insurance transactions, the way in which we hire and retain and motivate people, and the way in which we look at potential acquisitions or potential stock investments or potential businesses that we bought. And so the last set of numbers. So as I said, when Markel went public, it was about 500,000 shares that were sold at $8 a share. To give you some sense of the size of what you could pull off an IPO back in 1986, and the total market cap of the company was $30-some million. And today that stands at $10 billion. A couple of acquisitions, a couple of financings along the way, but mostly that has been bootstrapped and just been that first category of businesses that have earned good returns on capital and reinvested it and compounded it. Bought a lot of other insurance companies, bought the Markel Ventures sets of businesses, which I think many of you in town, several familiar faces around town, an eclectic set of businesses that everything from AMF Bakery Equipment, which was our first deal here in town that Ken Newsom runs, to the most recent thing we bought was a company called Cottrell out of Gainesville, Georgia. That if you're out there on the highway and you see a trailer with 10 or 12 cars being hauled, odds are that's actually a Cottrell trailer. They're the leading company at doing that sort of thing, and a lot of stuff in between and along the way, and that amounts to about $1 billion business these days. The insurance business itself is running at about a $4 billion rate and does business all around the world. Literally about 40% of the revenues of Markel would be outside the U.S. So it's been a fun place to be and a hell of a ride, and I hope that we've done some good for Richmond. And I know it's been good for this particular Richmonder, and I know a lot of you are familiar. But with that, let me stop talking and start answering questions. Well, I joke. I say we kind of have like 100 bookies around Markel. And if you think about it, on something like auto insurance, that Geico and State Farm and Progressive, they're world class. Those are really good operators at that sort of stuff. That is very actuarial, very scientific, very precise. I mean, the number of units and the number of miles driven, it's a law of large numbers kind of thing. So you really have very precise data on what it is you're looking at. On the kind of things that we would have, To take an oil rig as an example, an oil rig might cost $1 billion. In round number, let's just say it's $1 billion. So if an oil rig goes down, you're looking at $1 billion loss. We, by ourselves, and really no company can put up $1 billion line. So we might take $50 million or 25 or maybe even 100 at the outside, but that's kind of the size. So you're going to need a syndicate of insurers to come together and agree on what the pricing and rate should be. Well, fortunately, there's not just one oil rig. Around the world, there's 1,000 of them. And there is some data that would suggest every year one of them is going to go down, or three. I don't know what the numbers are, or once every 3 years. So you can take $1 billion and you can multiply it by that percentage rate, and that would be what would be known as the technical rate. So there's actually an actuarial indication as to that. And then, well, and my wife is trained as a chemical engineer, and she went through college and get a chemical engineering degree. And what she would tell you is that the only engineers who really know what they're doing are civil engineers. And what they would do is they would calculate the stresses and loads on a bridge and figure out what the materials need to be for that. She says they calculate what they really need, and then they double it. So similar kind of theory. You would get some sense of what you think the technical rate would be, which is basically, if a loss happens, how much is the loss? What do we think the odds of that are? And some of that is based on data that you have. Some of it is using your judgment, your experience, your professionalism to assign reasonable odds to that, and then coming up with a price and having some margin of safety that the price you can actually get is in excess of that, and then having 100 different people do it in 100 different sorts of product lines, so that if you get it wrong in any one place, I mean, we have house limits as to what we would put up on any one risk. And if an oil rig in the Gulf of Mexico goes up, something bad happens to it, generally speaking, that would not correlate at all to an oil rig in the North Sea, to a bass boat with too big a motor on it, to a children's summer games. Those are uncorrelated risks. So even if you get one of them wrong, generally speaking, that should not infect the rest of the book. So you're making it up, and then you're charging more for the next one. It's an iterative process that has the actuarial data plus judgment plus experience plus firewalls and limits to make sure you can open up for business the next day. There's people challenges of any integration, and that's where I think that focus on the culture, the values, the integrity piece, that's actually really helped us. And we're very explicit about that. The annual report is consistent year after year after year after year. The behaviors of the people who do well are consistent year after year after year. And that tends to attract people who like that. And people who don't like that or think that's a little hokey or, they tend not to last. And they just don't like Markel. So there is a selection reinforcement process that happens through the culture that has been very productive. Technically, we would have the exact same challenges that everybody else has. IT being huge, making systems integrate in. The amount of knowledge that I have about IT rounds to zero, but the only thing I say, and I have one of these titles, co-CEO, when it comes to IT, I say, I am the director of unsolicited opinion. So what I keep up structurally is that we have sort of Lego block type structures where there are things that need to be done through IT, and when that process no longer is the appropriate one, can we just take that Lego block out and put a new Lego block in? And all I know is we keep spending more and more money in that realm all the time. I'm not aware of any business where that's not the case. So that's a challenge. But our challenges would be no different than anybody else. And as long as you don't lever it too much, you're reasonably thoughtful, and you have the ability to bounce back from your mistakes and learn and iterate to a better solution the next day, I think that's the best you can do. Fortunately, we're not doing space launches where you need to get that right. When you're going to the moon, there isn't a 7-Eleven on the way that you can stop at to pick up what you forgot. So our businesses are much less complicated than that. So the ability to stop along the way and resupply and get the stuff you forgot, that's a good thing because I'm not smart enough to do moon launches.